Welcome to Fat Profits Podcast, Property Finance and More. I'm Corey and I'm here to talk about all the current headlines around investing. Some of the things we're going to cover today, and I'm sorry if it feels like a ramble, we're going to cover the debt to income ratio changes. We're going to cover the trust and company lending, basically what they're calling it, the investor crackdown, inflation and how much it shocked us, the RBA interest rates and what we're expecting, and also there's some talk about is the Australian housing bubble about to burst? So here we go, here comes the ramble. Debt to income ratios. Look, essentially the APRA, the regulator for banks, came out in, I think it was December, and said investment lending is too high, so we want you to stop and calm down. When you look at every settlement every month, about 42% of settlements every month are investors. It's way too high. APRA want that down at 20%. It's a pretty big cut. So what they've done is they've gone and put the screws into the banks and said, we want you to crack down on this. We want this to be reduced to 20%. And so how they're going to do that, they're going to make it mandatory to have a 6 debt to income ratio. So basically 6 times what you earn is the max you're going to be able to borrow. My opinion on this, I don't think this is going to do anything, guys. I don't think it's a big concern. I don't think this is the area where you're not going to be able to keep progressing your portfolio. At the end of the day, 6 is quite a lot to borrow. And the APRA are only really focusing on ADI banks. So this is deposit holding banks. This is your first and second tier banks. These are the big four and everything around it. The non-bank lenders, they do not care. They might adopt a little bit of concern, but at the end of the day, they're going to keep lending to you. There's going to be some other options. Trust and company lending, we saw that, I think APRA in the background, this was another way they ought to put the screws in. It's not something that they've announced. They announced the debt to income ratio, but we can tell from around October last year, banks seemingly in the same day and overnight all of a sudden pulled out of trust and company lending. So this is the strategy that a lot of people have been talking about publicly. Whether you agree with it or not, there are some people that probably shouldn't do it. It's probably prudent for some people, but ultimately people have been maintaining borrowing capacity. So basically they'll borrow in a trust, they'll go to another bank and say this debt is profitable, and they keep borrowing. At the end of the day, this is probably the area where it's going to be affected most for 2026. You know, in the previous episodes, we've talked about what was possible in 2025 is now not possible in 2026. So we are going to see the aggressive and risky lending calm down. This is probably where the percentages from 40% to 20% is going to be possible. My prediction, I don't think we'll hit 20%. I think we'll hit 30%. Reason I say that, most of the banks, even though the whole settlement section is 42%. Most banks are sitting at a 10 or 12% book anyway, so they're well below the 20% that is required of them. I think what it will probably be that calms things down. I think people that have been aggressively investing and aggressively lending, I think that will pause. I think the mortgage brokers that probably aren't prudent and probably don't know the strategies won't be able to continue building portfolios for people. The example I use is during COVID and real estate agents. Everybody who had no experience could sell a property very easily. As soon as things softened and got more difficult, the people that had a track record, the real estate agents that had a track record were able to keep selling, and the people that didn't started to, I guess, pull out. It's going to be the same for mortgage brokers. For example, Source Financial, we know exactly where to go. We already are doing these things. Before October happened, we were already finding these lenders. I think the big thing here is that building a big portfolio within 1 year isn't possible. I think property needs to be seen more as a tool. It's not something to store away. It's something that you might hold for a year, but you need to be willing to sell to keep going and building portfolio, particularly if cash flow is the objection. Inflation. Look, we knew it was going up. We didn't think it was going to be that much. I think it was something like 0.8% was the most recent figure that it increased. So that triggered an interest rate rise in February. So I think most people were predicting at least 1 or 2 interest rate rises at the start of the year. It's looking like we're probably going to hit another 3. So in the total of 1 year, 1% increase in the cash rate is potentially expected. The next one going to be in May and June, and then probably from there it's going to be October and then December. I think it will crack down. It's interesting watching the RBA and the Treasurer, Jimmy Chalmers, talk about inflation, because obviously someone is telling furfies. We've got the RBA talking about and has admitted, because they've been questioned, that spending from the government has contributed to a surge of inflation. But current Australian Treasurer Jim Chalmers insists it's not, that it's the private sector. So he's blaming you. So obviously someone's lying there. So I think you need to vote with your feet. But I think it's going to continue to be an issue. The Australian government has overspent in areas, so inflation will continue to be an issue, and it's going to affect you mortgage holders. And even looking at the stats for mortgage holders, it's the average stats that 85% of us have 4 years of repayments. So it's obvious that it's not the mortgage holders causing inflation. It's definitely outside sources. Another area that's probably a little bit touchy, housing costs seem to be making up 22% of the surge of inflation. Housing costs cover building, housing costs cover house purchasing, housing price costs things like rent and electricity and all those types of things. That's pretty huge. Some people have contributed that to immigration. I'm not going to say whether immigration is right or wrong, but it's definitely affecting house prices because there's more people trying to buy. And if you look at how many people on average, I think it's like 40 to 60 people on average are applying for rental properties. So there's definitely areas there that are contributing to inflation. Again, we talk about building. I think 40% of a building contract is tax. So obviously the Australian government's spending that tax incorrectly. But if property prices are going up and there's not enough houses and there's immigration, we've got to construct, which will also, if we need to construct more, that's going to contribute to inflation as well. So some concerning little statistics are starting to hang around, and some things aren't being handled right. So look, I think the interest rate position, I think there's going to be another 3 increases. I think it's going to be very volatile. So if you had a mortgage of, say, currently $800,000, your mortgage repayments would have gone up by $200 this month. If we get another 3 increases, it's pretty significant. It's up to $800 to $1,000 in more repayments per month. That's some people's grocery bills. Very concerning. There are some people thinking that will decrease the property market. Well, we had 12 rate hikes not long ago, so potentially we're going to be okay. The other thing is there's an author named Phil Anderson. He wrote a book called The 18-Year Property Cycle. So people are comparing the GFC to now. They believe that there's going to be a burst in the cycle. He believes that there are 4 key steps to this. One's at the beginning when obviously things start to, after the dip or after the crash, that confidence starts to come back in. Then there's a mid-cycle confidence and a dip, meaning that prices started to go up, but they've dipped a bit. Then there's a boom. And then there's a crash, and some people believe that we're at the start of that crash, so we're coming up to 18 years since the GFC. I think the difference between the GFC and now is that usually a property crash or a property cycle coming to a burst, which Australia hasn't really had. We've had some small decreases, around 10%. That's quickly recoverable. But the real difference is usually when you look at those things like America, it's usually because there was not access to credit. Credit wasn't free flowing. There wasn't access to money from banks. Banks were going bankrupt themselves, and they had to get buyouts from the government and grants and all those things. Australia is not in that position. So if you ask my opinion, do I think there'll be a softening in certain markets? I think yes. I do think there's going to be very healthy level of growth still. Still the national average, I think we're going to still hit 6.8%, but it's all going to come down to access to credit, which we still have plenty of, and banks want to give money. So this is the news headlines. These are the things we're going to talk about occasionally. Definitely comment if you want to hear about specific things, but if you want help from a mortgage broker or an accountant, please go to the description and reach out to us. And even if you just want to have a chat, please do so.